What's up, guys? Screech, based accountant here. A couple weeks ago, I got asked to present to a group of online entrepreneurs. So I put a presentation together, did it, it went great, but I figured I might as well make a video going over that exact presentation I did and post it on here for you guys. So it's kind of like a master, accounting 101, financial management tips, specifically for online business owners. So let's just jump right in, get after it. So like I said, best accounting and financial management practices for digital business owners. Steps in entity formation. A lot of people are always like, do I need an LLC? Do I not need an LLC? You don't need an LLC to start doing business. You definitely want to make sure that there's a product market fit, a service market fit. Maybe you get a couple clients under your belt first, just so that for sure that you can make money doing that. But once you know that, you got something legit and promising going, what I recommend is you form an LLC, and 99% of the time in your own state, unless you're making multiple 7, 8 figures, you really don't need to incorporate in some other state. A lot of the reason people do that is actually for privacy reasons too. So form an LLC in your state, you get an employer identification number, and then you take that paperwork and you go and open a business bank account, set up your payment processor, Stripe, whatever, you get paid. Now, it's really easy to get a business bank account, and it's super important. And that's one of the main reasons that I recommend an LLC. It just makes that a little bit easier to do typically. You take that LLC paperwork, you take that EIN paperwork, take it to your local credit union, your bank, wherever, boom, business bank account done. Checkings, savings, and they'll usually give you a business credit card so you get access to more capital as well. Those are some of the benefits. Easier for the bank setup. It allows us to make an S election down the road. You get some legal protection from keeping business and personal separate. So that is that. So talking about bookkeeping a little bit here, why it's so critical. So I like to say that great bookkeeping is the foundation of great tax planning. And what I mean by this is if you have your personal and your business, like if you have that money coming in and out of your personal accounts, it's not separate. And, 9 times out of 10, if you're wheeling and dealing your business stuff out of your personal account, when it comes tax time, you're going to miss expenses. There's going to be stuff that you paid for your business out of that personal account that's going to get missed. We don't want to miss anything. We don't want any of those expenses to fall through the cracks. That's what I mean there. Having those separate bank accounts allows you to more easily track and keep separate, the business and personal stuff. And then accuracy and decision making, by having it separate and having everything accounted for, we're able to have cleaner financial data, and it makes it so that you can make better business decisions because you're seeing exactly how much you made and exactly how much you spent and on what. And like I've mentioned a couple times, it keeps the business and personal separate. And as far as loans and exiting, so if you ever needed financing or if you're ever looking to sell your business, you're definitely going to need accurate financial statements in order to do so. So those are a couple reasons why bookkeeping is very crucial. So now let's talk about what a deduction actually is according to the tax code. So in the IRS tax code, it says that they allow for the deduction of ordinary and necessary expenses that are paid during the taxable year to carry on your business or trade. So a little note here, a deduction reduces your taxable income. It is not money that's refunded to you at the end of the year. So if you had, $150,000 in sales and you had $50,000 in, business expenses that were tax deductible, it would then make your taxable income $100,000. So that $150,000 of sales minus the $50,000 of tax deductions or write-offs that qualified, then now your taxable income is $100,000. So it allows for anything ordinary and necessary to be deducted, but what does that mean? They say it's a gray area really. So an ordinary expense is one that's common and accepted in your industry. A necessary expense is one that's helpful and appropriate for your trade or business. So this really is industry to industry, right? Like what is ordinary and necessary for a content creator is going to be different than what's ordinary and necessary for a landscaper, right? Like they're just inherently different businesses. So this is definitely something or you can get creative and you want to navigate this appropriately with your accountant. And here we have 11 common tax deductions for online business owners. I actually made a whole video just on this. I'll link it up at the top right here for you to go watch that if you want a little bit more in depth. Essentially, the 11 are travel, and this is my favorite one. If you're online, you probably have clients in person somewhere. Fly out, go meet with them, have an agenda for a couple days to do some stuff with them. The flights, the meals, the hotel rooms for all those days that there's a legitimate business purpose, all tax deductible, which is awesome. And you got advertising, the different softwares that you use. Your home office is a great one. You get $5 per square foot up to $1,500 or 300 square feet. That's one that gets missed sometimes. That's a really good one. Coaching and education expenses, like if you want to join a mastermind or a coaching group, your phone and internet bills, all of your accounting, legal, consulting type fees, your computer equipment, payments to employees, contractors, all that good stuff, meals and mileage. Like I said, I have a whole nother video going more in depth on this. I'll link this right here. My name's Dylan, and I own Sledge Accounting, where we provide full-service accounting, advanced visual monthly reporting, and unlimited consulting for online business owners. Check out the link in the description below to book a free strategy call with me to talk about your accounting situation and see how we could help you out. I've talked a lot so far about keeping business and personal separate. Now, what does this actually look like? It looks like having sales come into your business account. You're purchasing business expenses with your business accounts. When you're wanting to make a personal purchase, so you have your business account, you make all this money, that's awesome. Okay, now I need to pay rent, I need to buy groceries, I need to put gas in my car. You just transfer that money from your business account to your personal account and then make the purchase. And same thing goes for if you need to make a business purchase. And if you don't have enough money in there to do that, you just transfer it from your personal card into your business account and then make that business purchase, because we don't want to miss out on those. And then we want to pay off our business credit cards with the business checking account. We want to pay off personal credit cards with your personal checking account. And that's really how it's done. That's really how we keep them separate. And if you're ever unsure about what should be going on your personal card or what should be going on your business card, just ask your accountant, and they should have a good answer for you. Now, understanding business taxes. Having an LLC does not change how you are taxed. This is a big misconception. Just having an LLC right off the bat isn't saving you on taxes. Not directly, at least. I would argue that it does save you on taxes if you get those business bank accounts and you're keeping great track of it, better track of your business expenses and income than you were previously only having personal accounts. In that regard, I think it'll save you taxes because you're more organized and we're not missing any of those expenses. So if you are a single member LLC, you'll still be taxed as a sole proprietor. If you have a multi-member LLC, you'll still be taxed as a partnership. But having an LLC does allow you to elect to be taxed as an S corporation. That is big time. We'll get into that a little bit more in just a second. Now, the income you receive from business activities is going to increase your taxable income, and the business expenses that are tax deductible are going to decrease your taxable income. Now, I want to talk about the S-Corp a little bit. So essentially, the main advantage of an S-Corp is it's helping you mitigate self-employment taxes. So when you're a normal employee, you're working for somebody else, they're going to match your Social Security and Medicare taxes. So you'll pay a little bit over 7% and they'll match the other 7.65%. Now, when you become self-employed, the difference is you're now responsible for paying that entire 15% as opposed to only paying half of it. So the S-Corp is a way where we can mitigate this a little bit. So as an S-Corp, you pay yourself in two ways. You take a salary and you take a distribution. Now that the salary portion is the only part that's subject to that 15% Social Security and Medicare tax. Now, when you're just a normal sole proprietor, just a normal single member LLC, your entire, net income is subject to that 15.3% tax up until about $160,000 of net income, which is significant. I mean, do the math. What's 15% of $160,000? It's a significant amount. So this is a great option to help reduce your tax liability, and it typically should only be done after you're making about $70,000 in net profit per year. And you 100% should not do this election on your own. You should definitely speak to a trusted accountant, maybe even a lawyer as well before doing this. I have a little case study here showing you some of the potential savings. So let's say right here, you're just a single member LLC on the left in the before section, single member LLC. You made $150,000 in net profit. You had an awesome year. So just in self-employment tax, which is Social Security and Medicare tax, that's the same thing. You would end up paying $22,800 just in self-employment tax. That is so much. So what we can do is, as an S-Corp, you pay yourself a reasonable salary. And, this is kind of a gray area too. It's supposed to be, your reasonable salary is supposed to be how much it would cost to replace you, like to actually hire someone to do what you do. Something that's reasonable for your role in your business. A lot of times that's right around the 50% mark, not always, but let's just say for this circumstance, it's half. So 75,000 S-Corp salary. Now, instead of that whole $150,000 getting hit with that 15% tax, it's only going to get hit on that $75,000. So in this case, you end up saving $11,400 just by making this S election. Something I do want to mention too, there is a little bit more administrative costs with doing this. You do have to run payroll to yourself. There's those payroll tax returns. Your tax return is going to be more expensive at the end of the year. A couple of those things. And those are some of the reasons why you want to wait till you're at least at $70,000 net profit or more to do something like this. There's a little bit more about the S-Corp. I do have a more in-depth video about this as well on my channel. You can go find. And from here, I just put this graphic in to kind of show the kind of what it looks like from start to finish, from setting up your business to the tax return at the end of the year. So you're going to form that LLC like we talked about, get that EIN like we talked about. You're going to take those and go open a business bank account. And then from there, you're going to connect those business bank accounts to an accounting software like Xero or QuickBooks. I prefer Xero. Or you're going to have your accountant do this, like myself. And then you're going to keep track and categorize those incomes and expenses. And that's really what the bookkeeping is. And then from there, we can generate financial statements in the accounting software because we've kept track of everything. So now we can see exactly how much we made, exactly how much we spent on certain things. And these financial statements is really, where the tax return is built from. Those financial statements is what gives us the information needed to build those tax returns. So that's kind of, how it flows. So you can hire an employee or a contractor. So with the employee, you'll give your new hire a W-4, you'll give them a W-4 to collect all their necessary information. And a W-2 employee is considered an employee of the company. You, as the employer, have control over the work that they perform. You set their schedule. You provide the tools and equipment for them to do the work. You might provide some benefits as well. In this case, the employer matches the employee's Social Security and Medicare tax, as well as you'll pay state and federal unemployment taxes on them as well. So those are kind of the advantages of the employee. You get to set their hours, you're controlling the work they do, a little more structure, that type of stuff. But you do have to match their self-employment tax, not the self-employment tax. You have to match their Social Security and Medicare tax, as well as pay some state and federal unemployment taxes as well. So with the contractor, you'll give them a W-9 to collect all of their necessary information. Now, the key difference is the 1099, they're hired to perform specific services or projects, but the contractor has independence and control over how and when the work is performed. They do it on their own time and they do it with their own equipment. And the contractor is responsible for paying for the full portion of their Social Security and Medicare taxes. So those are some of the key differences between hiring an actual employee who is W-2'd or hiring a contractor who's 1099. All right, so you definitely should be talking about your situation with your accountant, what you're trying to do within the next few years, what your goals are, because depending on this, honestly, can change how we should approach the accounting and the tax planning for your business. So if you're just trying to pay the absolute least amount of tax possible, then we should show low profit for your business and we should accelerate and accumulate lots of expenses to reduce that taxable income. But if you're looking to maybe sell the business in the near future, or if you're wanting to take out any big loans, like maybe for a house or an investment, especially within the next 2 years, then we're going to want to show more profit because, when you go to get financing and you go to borrow, they're going to want to see those financial statements. And if you hand them over financial statements and bank statements and it shows that you're not making anything, then you're not going to qualify for any financing, right? So, I really like this. Another accountant actually said it this way. I really loved it. It says, everyone wants to pay zero tax until they go to borrow money and can't qualify for anything. You need to understand that paying your taxes is purchasing your borrowing power. So there's just something to think about. It's not always the most advantageous to pay the least possible amount of tax. There's 3 ways to mitigate your tax liability. The main one is timing. So if we want to defer income into the next year, that would save you some tax there. Maybe instead of you have a big client wanting to sign on, it's December, it's a huge amount of money. If you just wait to collect that cash and sign them on in January, that's gonna, you're gonna miss the income for that year. Accelerating expenses. If you made a bunch this year and maybe you need some new equipment, need to make some new hires, maybe purchase a big software contract, maybe you pay for it a year in advance, that type of thing. That would be accelerating your expenses, which is going to reduce your taxable income. The other way is to spread the tax liability across multiple taxpayers. So this typically happens in the form of having partners. So, if you have a partnership, it's you and someone else, then it's going to get split up 50-50, right? You can also change the character of the tax. So this would be like waiting on your investment to make it a long-term gain instead of a short-term gain, because long-term gains are taxed at a lower rate than short-term gains. Now, here's 3 ways to increase your profitability. And there's a glaring difference between the businesses that do this the right way and the ones that do this the wrong way, as well as, their longevity in business. So there's 3 primary ways to do this. The first is you can increase profitable sales. The second is you can reduce variable costs. And the third is you can cut operating expenses. And by reduce variable costs, like if you were an e-com company and you were selling swimsuits, the cost of goods sold, that's how much it costs you to make that swimsuit, essentially. For a lot of these service-based online businesses, this would more so be the cost of fulfilling your services. So cutting operating expense is the easiest and quickest fix, but this sacrifices the long term in favor of the short term and is often unsustainable. The best companies focus on increasing profitable sales and reducing their variable costs, and this is playing the long game. Understanding key financial statements. So the 3 most important ones I would say are the income statement, the balance sheet, and the cash flow statement. So the income statement is going to track your profit and loss over a period of time, and it's really your performance over a specific period of time. It can be compared to the letter grade in a class. It's a good way to think about it. So if you're in school, this would be like getting an A or B or whatever in your economics class. And essentially, the function of this statement is it's your income minus your expenses is going to give you your profit or loss. Now, the balance sheet displays assets, liabilities, and equity. It's the health and sustainability at a given period of time. And this can more so be looked at as the overall GPA. So just because you got an A in one class doesn't mean that the health of the entire business is actually good. You could have had a really, really good month of May. That doesn't mean that your first quarter was very good. You see what I mean? So in the equation for this is really your assets equals your liabilities plus your equity. And that might not mean anything to you, but your accountant knows. And then you have your cash flow statement. And this is showing the inflows and outflows of cash, providing a snapshot of a company's cash position. And it's really about your ability to generate and manage cash. So creating a financial plan, we want to set goals and KPIs, also known as key performance indicators. So we want to determine financial benchmarks and targets and the inputs needed to hit them. And we want to create a budget. We want to have at least a pretty good idea of realistic expenses that you're expected to pay in a given month, at a given quarter, and what we're expecting income-wise. We want to make sure we have enough that we can at least pay for those expenses. And then we want to track our progress. And this is really what's nice about having an accountant is they're going to keep track of it for you. They're going to be able to review the performance with you, all that type of stuff. So we want to review these financial reports often. We want to track our progress towards these goals and KPIs. And, ask yourself, did you hit the numbers you were looking for? Okay, yes or no, why or why not? Some tools and resources for financial management. I've talked about connecting your business bank accounts to accounting software. I would say Zero. I think Zero is better than QuickBooks. That's my personal opinion. I think it's a little bit more user friendly, especially for non accountants. But either one of those, Wave is another great free option. One of those three probably. And then on the personal side of thing, I know this is tailored to business, but for personal finance tracking and seeing your net worth, expenses, that type of stuff, Mint or Empower, those are both good ones. Fathom HQ, that's another tool that I use at my firm for some advanced reporting, some advanced forecasting. And really, probably the best resource is having a trusted accounting partner, someone that's on your side, on your team, and responds incredibly swift. They're on top of it. You're not waiting 3, 4 weeks to get an answer back. Strategies for long term financial success. We want to pay yourselves first or pay your business first, right? You want to set aside a percentage of income personally and in the business and have it put aside before you start paying out your business expenses. Because what's more important, your business or, the collectors, right? And it's kind of just a subconscious thing, right? Like we just want to make sure that we're positioning ourselves as the most important, essentially. And it's going to help you stack cash. It's going to help you have a good cash reserve, which is going to allow you to stay in business longer. We want to invest wisely. We want to choose investments that align with your values and have a track record of success. And by investments, I really mean people. I really mean the clients, the type of clients that you work with, the type of employees and contractors that you work with. It's so important. No one really gets it right on the first go around, but do your absolute best. And when you have an A player, you come across one of those A type players, do everything you can to keep them because they're very hard to come by. Be proactive, stay organized. That's the next one. We want to consistently review those financial reports. We want to keep ourselves accountable in this regard. And we want to maintain those accurate financial records so that we know what's going on at all times financially in our business. The last one is we want to focus on our inputs over the outcomes. So we need to double down our efforts on the inputs that will lead to you hitting the outcomes you desire. So instead of thinking, oh my gosh, I need 20,000 a month this month, I need to hit 20K a month. Okay. Instead of putting that as the goal, we should have the inputs be the goals. Okay, I'm going to send 1,000 cold emails. I'm going to send 1,000 cold DMs. Okay, I'm going to make 1,000 cold calls. I'm going to do this, this, and this so that I get the outcome I want versus the outcome that you want being the goal, if that makes sense. Mitigating risk. Crazy shit is always bound to happen. It just does. COVID is a great example. And if you're watching this and you're on, money Twitter, this type of thing, I know we don't really participate in recessions around these parts, but times of hardships will be bound to come around when you're on the quest for greatness. So here's a little list to survive and thrive in extreme economic climates, which honestly could come at any time. The biggest one is having a big cash reserve. One of the businesses I worked at in 2019, 2020, as COVID hit, it was before I had my own thing. But the reason that they thrived and stayed alive is because they had so much cash built up that they didn't have to lay anybody off. They could still have employees going. They could still have marketing going, all that type of stuff. So having a big cash reserve is definitely number one on this list. But we want to be able to control costs. Maybe we adjust pricing. We want to delay hiring in these climates and retain A players like I talked about. We want to have a big emphasis on cash flow. We want to see how we can be more productive, more efficient, and we would want to invest in rather than cut marketing, and we want to lead with empathy. And having a specific list of discretionary expenses that you could cut immediately if you had to. And like I said earlier, prioritize cash flow, boost cash reserves. When times get tough, things get stressful, emotional reaction clouds judgment. We all know this. So we want to have a plan like this in place before you get to the tough time. And then we just know, okay, this is how we're going to react when this happens, and we know when to react as this stuff happens. So this is another part of the business stuff where we want to be proactive. Staying on top of regulations and compliance. We want to stay up to date. We want to regularly review the IRS and state regulations for compliance. We want to have a professional in our corner, like a great accountant, a great attorney. Really just are so valuable. And don't cut corners. Um, there's a lot of bad info out there. A lot of people giving advice that aren't accountants, that aren't lawyers, just spewing stuff out there. Don't cut corners. It's just never worth it. Why outsourcing is the key to success. Now, if you're a successful business owner, you know this already. But we got to delegate. We got to delegate tasks to free up more of our time so we can spend more time working on your and your business's unique skills and services, your strengths. We want to delegate our weaknesses. And, for 99% of the population, one of those weaknesses is accounting, bookkeeping, and taxes and law. Um, one of the phrases I like is, you go to your barber to have your hair cut. You don't try to cut your own hair. Why would you try to do your own accounting? So highly, highly recommend outsourcing your accounting to a trusted professional. And if you didn't know, I own Sledge Accounting. We are a full service accounting, advanced monthly reporting, and unlimited consulting business for digital business owners. So really everything we just talked about, we can help you navigate. We simply handle all of it for you. We do it proactively, we do it year round, and we do it all in one place. Now I'm going to link the document that I presented in the description. So it has a video explaining a little bit more about our services, as well as our website embedded. You can follow me on Twitter for more accounting and business content, as well as I have a newsletter. Go join those things. Make sure to like and subscribe if you found some value out of this video. And, I really, really hope that this was valuable for you. If you have any accounting questions that you'd like me to go over or make a video about, please drop a comment below and I'd be happy to make a video about it for you. Thanks so much for watching. Have a great time. Go make some money, baby.